Hi, my name is Pieris Markou, and I would like to welcome you to our second quarterly tax update for 2016, brought to you on a very hot and sunny day right here from the beautiful Limassol Marina, an exclusive waterfront development combining elegant residences and a full-service marina accommodating more than 650 yachts with its own shopping and dining area right in the heart of Limassol. Such developments are becoming more and more popular in Cyprus, as these can be of particular interest to those seeking investments for citizenship, offering them the opportunity to combine the EU citizenship with prestigious investments on the island. The main aim of our quarterly tax updates is to give you some high-level insights to major tax developments in Cyprus and brief updates on developments around the world that may have an impact on companies operating from Cyprus. In today's webcast, we will look at the recent developments in local tax legislation, new regulations, and circulars issued during the quarter ending 30 June 2016. We will update you on new tax treaties signed or coming into effect during the period, and briefly cover some important international tax developments. We will close off today's webcast with a quick reminder of the tax deadlines coming up in this next quarter. Let's start by looking at developments in the local tax legislation. In this quarter, we had the issue of a decree for the imposition of a fee on rulings, changes in the tax laws in connection with leases, and a number of circulars and announcements. Let's have a look at the details. In April 2016, the Council of Ministers issued a decree providing for the imposition of an administrative fee for the issuance of a tax ruling by the Commissioner of Taxation. According to the decree, a fee of €1,000 is payable to the tax authorities by the taxpayer requesting the ruling. The fee increases to €2,000 in cases where the taxpayer would like to obtain the tax ruling within 21 working days from the date of submitting of the request. The fee is only payable through jccsmart.com. A copy of the payment receipt should be submitted to the tax authorities together with the ruling request. The above-mentioned fees apply to tax rulings requests which are submitted to the tax authorities from 16th of May 2016 onwards. The main aim of the issue of this decree was not so much to collect more revenues, but more in order to reduce the number of inquiries being submitted to the tax authorities that were not really considered as rulings, but more of inquiries. The decree is also a follow-up to the circular issued in September 2015, which attempted to regulate the process of submitting rulings, ensuring a specific format that should be followed amongst other requirements that must be met. In April 2016, amendments were voted to the Special Defense Contribution Law and Capital Gains Tax Law in connection with the tax treatment of finance leases. The key changes are as follows. The SDC law was amended so as to clarify that a lease payment in respect of a finance lease with a right to purchase of the property by the lessee does not constitute rent and thus is not subject to SDC. The capital gains tax law was amended so that the following are exempt from capital gains tax: a simple finance lease or a reverse finance lease as defined in the finance lease law, transfer of assets from the lessee to the lessor under a reverse finance lease, and transfer of assets by the lessor to the lessee under a simple finance lease or a reverse finance lease. It is important to note that the exemption only applies provided that the lessee is entitled to purchase the assets leased and the lease has been registered according to the immovable property registration and valuation law. You will recall that the amendments to the capital gains tax law, which came into force on the 7th of May 2015, provided, amongst others, for the exemption from capital gains tax of direct or indirect disposals of immovable property carried out under restructuring arrangements until May 2017. On 31 December 2015, this exemption was extended up to 31 of December 2017, along with the voting of a comprehensive package of tax reliefs extending the exemption to the income tax law, the SDC law, the stamp duty law, and the VAT law. In May 2016, the Tax Department clarified through an announcement that agreements concluded during the period from 7th of May 2015 to 31 of December 2015, which was the date the new law was voted, will follow the same tax treatment as provided in the amending laws voted on 31 December 2015. In May 2016, the Tax Department circulated the following 10-year government bond yields for the purpose of calculating the notional interest deduction for the tax year 2016. You will recall that the NID is calculated by multiplying the new qualifying equity by the relevant reference rate. The reference rate is equal to the 10-year government bond yield of the country in which the qualifying capital is invested in, plus a 3% markup, subject to a minimum equal to the 10-year Cyprus government bond yield plus 3%. With regard to the automatic exchange of information on tax matters, Cyprus has taken steps to harmonize its domestic law with the EU directives by amending on the 25th of April 2016 the Administrative Cooperation in Tax Matters Law and by issuing a decree on the 20th of May 2016 under the Assessment and Collection of Taxes Law. Furthermore, on the 27th of April, the Cyprus Ministry of Finance announced its intention to amend the Cyprus legislation in relation to country-by-country reporting following the EU directive implementing BEPS Actions 13. Member States must transpose the EU directive into national law by the 4th of June 2017, but with effect for accounting periods commencing on or after 1 January 2016. Let's now look at the proposed changes in the immovable property tax law. In an attempt to modernize and simplify the framework governing the taxation of immovable property, the government has submitted the following amendments to the immovable property tax law, which are currently being discussed at Parliament. The proposals provide for the imposition of immovable property tax on the basis of a single tax rate of 0.05%, the provision of a 20% discount for timely electronic payment of the immovable property tax via electronic platforms or credit institutions, or a 17.5% discount for timely payments made at the Tax Department's cashier desk, the abolition of the municipality levies, the reduction of transfer fees by 50% for all immovable property disposals, and the imposition of a 19% VAT on the sale of land, including the sale of shares of companies owning land. During the second quarter of this year, we had the signing of a new treaty with Latvia and the entering into force of 2 new treaties. We are also expecting some developments with the long-awaited negotiations with India. Let's have a look at the details. On the 24th of May 2016, Cyprus signed a tax treaty with Latvia. According to the tax treaty, the following withholding tax rates apply. Dividends and interest, a zero withholding tax will apply to dividends or interest paid to a company other than a partnership resident in the other state that is beneficial owner of the dividends or interest. Otherwise, a rate of 10% will apply. For royalties, again, a zero withholding tax will apply to royalties paid to a company other than a partnership resident in the other contracting state that is the beneficial owner of the royalties. Otherwise, a withholding rate of 5% will apply. It is worth noting that Latvia does not currently levy withholding tax on dividends, interest, or royalty payments, except where such payments are made to persons resident in a jurisdiction included on a blacklist issued by the Latvian government. The provisions of the treaty shall have effect on both countries on or after 1 January following the date the treaty enters into force. The tax treaty between Cyprus and Bahrain, which was signed on the 9th of March 2015, entered into force on the 26th of April 2016 and will come into effect from 1 January 2017. A reminder of the rates that apply to the treaty: dividends, interest, and royalties are all subject to zero withholding tax. As Bahrain does not currently levy any withholding taxes on dividends, income from debt claims, or royalties, the tax treaty provides certainty that there would be no withholding taxes on payments made to Cyprus should Bahrain decide at some point in time in the future to introduce withholding taxes under its domestic law. Through a circular issued on the 13th of June 2016, the Tax Department announced that the treaty between Cyprus and Georgia, which was signed on the 13th of May 2015, entered into force on the 4th of January 2016 and will be effective on 1 January 2017. As a reminder, the tax treaty provides for zero withholding taxes for dividends, interest, and royalties. Finally, there are some developments with the Cyprus-India tax treaty. A delegation from Cyprus is expected to visit India during July 2016 to revisit the existing tax treaty with the aim to finalize the revised treaty by the end of the year. According to the statements of the government officials, the Cyprus side is proposing changes in the tax treaty along the lines of the protocol recently signed between India and Mauritius. Cyprus was declared as a notified jurisdiction by India in November 2013. As a result, any payments made from India to a person resident in Cyprus is subject to 30% withholding tax. It is expected that the revision of the tax treaty will restore the status of Cyprus with retrospective effect, allowing the refund of any tax suffered under the notification process. For the international part of this quarter, I will briefly update you on the developments within the European Union, especially with regard to the conclusions on the anti-tax avoidance package announced in January. We will also look at the ongoing developments on the consultation processes, on the BEPS actions, and recent announcements on the tax transparency. Let's have a look at the details. On the 21st of June 2016, the EU finance ministers reached a political agreement on the Anti-Tax Avoidance Directive, the so-called ADAT. The ADAT sets out certain minimum standards that the EU member states need to adhere to in several areas covered by the OECD work on the base erosion and profit shifting. What was left out in the last moment before reaching an agreement were the provisions of the switchover clause, which would have resulted in the taxation of disposals of shares, something that the Netherlands, amongst other countries, including Cyprus, were against. The items that were agreed on provide for the following: interest deductibility limitation, which is closely aligned with the BEPS Action 4, providing for a minimum interest deduction of up to 30% of tax EBITDA. Member states can choose to set a lower limit. A number of other discriminatory items also allow member states to provide for various specific provisions in implementing this rule. Controlled foreign company rules, which again are in line with BEPS Action 3. These apply to both subsidiaries and permanent establishments both within the EU and outside the EU. Rules to tackle hybrid mismatches, again along the BEPS Action 2. Rules for exit taxation. These will seek to tax companies on the transfer of assets, businesses, or tax residency from one country to the other. And finally, a general anti-abuse rule is introduced in order to tax arrangements or a series of arrangements put in place with the main purpose or one of the main purposes to obtain a tax advantage. Let's look at developments around BEPS. The OECD is currently at the consultation stage on how to address a number of challenges in implementing the actions arising from its final reports. More specifically, the OECD has recently released the following discussion drafts for public consultation: developing a multilateral instrument to implement the tax treaty related to BEPS measures, this is under Action 15, the interest deductibility, Action 4, and hybrid mismatch arrangements and branches under Action 2. Furthermore, it is expected that on the 6th of July, the discussion draft on issues involving interest deductions in the banking and insurance sectors under Action 4 will also be published. A recent EC proposal calls for the imposition of public CBC reporting requirements on multinational enterprises operating in the European Union with global revenues exceeding 750 million euros per year. The proposal would require for some multinationals to publicly disclose certain tax and financial information. Also, it's worth noting that on the 14th of April 2016, the G5 countries have launched a global initiative to develop a multilateral system for automatic information exchange of beneficial ownership information. Following a subsequent informal meeting of the ECOFIN, a total of 30 countries, including Cyprus, have committed to this initiative. We will close off today with the dates to watch out for during the next quarter ending 30 September 2016. 31st of July is the deadline for electronic submission of the 2015 personal income tax return by salaried individuals whose gross income exceeds 19,500 euros for the tax year 2015. Also, it's the deadline for the electronic submission of the 2015 employer return and employees' details, and the submission of the 2016 provisional tax return and payment of the first installment. 1st of April is the deadline for the payment of the 2015 tax balance through self-assessment by individuals and companies preparing audited financial statements. It is worth noting that although the deadline for the payment of the 2015 tax balance through self-assessment by salaried and self-employed individuals not preparing audited financial statements is 30th of June, such individuals can settle their tax liabilities without any additional interest or penalties by 31 of July. 31 of August is the deadline for the payment of the second installment of the premium tax for insurance companies under the life sector for the second quarter 2016. And 30th of September is the deadline for the electronic submission of the 2015 personal income tax return by self-employed individuals who do not prepare audited financial statements if their gross income exceeds 19,500 euros for the tax year 2015. The payment of the movable property tax for the year 2016, unless something changes under the provisions of the proposals currently at Parliament, and the payment of the third installment of the special tax levy by credit institutions for the year 2016. This concludes our webcast for today. If you have any comments or queries on the items discussed during this webcast, please email us on cyprustaxwebcasts@deloitte.com. Thank you for watching.